Okay, Hugh, we're good to go.
All right. At CFA Boston, we have on December 8th, Adapting to the New Normal, a playbook for virtual leadership. On December 9th, Career Chat, and it's on FinTech. And on December 14th, Investment Portfolio Risk for Insurance Companies, the CIO's Perspective. And then on December 15th, the current FinTech landscape, its evolution and future. Do we have any other announcements?
I have one. So Hugh, I'm going to send out a note. I was wondering if you could share it with the coffee membership. Tomorrow, we are doing a workshop on synthetic data generation. Steven Jansen, who wrote a book on machine learning for trading. So he's doing a workshop. He's going to be sharing some Jupyter files, and also he's replicating a paper. So it should be a fun one. It's tomorrow at noon from 12 to 1 o'clock. I'll share the link and you can forward it if you like.
Anything else? Any software to be sold or? Okay. Jess Stauth is managing director in Fidelity Labs, an internal incubator with a mission to create new fintech businesses that drive growth for the firm. Dr. Stauth was previously held roles as a managing director of portfolio management and research and trading at Quantopian, a crowdsourced systematic hedge fund based in Boston. Hopefully you can shed some light on the demise of Quantopian. And also director of quant product strategy, now Refinitiv, and a senior quant researcher at Starmine Corporation, where she built the global stock selection models and the design and implementation of the short interest model. Dr. Stauth holds a PhD in biophysics from UC Berkeley, and her research is focused on computational neuroscience. So with that, take it away, Jess.
Thank you. Thanks. Can you guys hear me okay?
Absolutely, Jess. Would you mind sharing your screen?
Yeah, so let's check if that'll, I closed everything embarrassing on there. We'll find out. Okay, now you guys can see this maybe?
Yes.
Absolutely.
Okay, and then if I see if I make it, whoa, okay, you know what?
It's good.
If this doesn't work, okay, so I'm going to show it. If you don't mind, if this is big enough, there's some really weird slide transitions, and I feel like I'm like an old person who can't do technology. I can't figure out how to get rid of them. So if you don't mind, I'm going to show it, show the slides in this frame. Is this big enough?
Yeah.
Sure.
Okay, great. And I might even be, I don't know if I can, you make it a little bit bigger. There's a way to get rid of that screen, that thing up there, but if this is good enough. All right, well, it's so great to be here, and I've done some panels and talks in this weird time where you can't see anyone at all. So it's so great to be able to see all of you, and I recognize a lot of familiar faces. So this is awesome. Really, really excited to come and chat with you guys. This is definitely not, I don't think, sort of a traditional Quaff-A-Few style talk. So feel free to storm out if this is not kind of what you wanted to hear about. I'm going to talk a little bit more about like high level perspective on how I've seen data science like work or not work in sort of more fintech applications. But it's also not that long. That's probably the other good feature about this talk. And so we'll leave lots of questions for Q&A. I'd not bring legal counsel to think about what I can say on and off the record about a current employer or previous employers, or any other employer I've ever worked for. So I'll try to be really, really thoughtful about answering Q&A. If you ask me what happened at Quantopian, I'll try to think about. I know there's just public stuff on LinkedIn, I can say that. So with that, I'll go ahead and get started, as long as you guys can say you can hear me okay. Which I think, all right, you have, yeah, you're saying that. And also one more disclaimer, I have 3 children and a new puppy during quarantine, and I cannot guarantee what level of background noise could erupt at any moment. So please forgive me if like complete pandemonium breaks out. I think I have sealed myself in a part of the house where folks can't come find me. All right, so I put this talk together, and Hugh saw me give this this talk to a student group at Harvard in the applied CS department. And so it's a little bit also kind of aimed at, you know, again, kind of folks that are not traditional quant background, a little more data science, a little more fintech, but you know, you saw that in the abstract, so it's on you. You came anyway. And what I thought, kind of trying to think through the motivation of a storyline that sort of speaks to something that I have learned in my career, is this theme around why. Why are you doing the work that you're doing? And I came across, you know, way late, sort of like 10 or 15 years late. So many of you, I'm sure, are familiar with the 3rd most watched TED Talk is Start With Why by Simon Sinek. And I am not a huge fan of management guru stuff, but this TED Talk is outstanding. If you happen to have not seen it, I have a link to it at the end of the slides. And I think it's outstanding. And I thought it would be kind of a nice, motivating concept for thinking through where I think a lot of data science and maybe even kind of quantitative modeling in fintech applications can sort of go off the rails. It's really easy to lose sight of the why, and because a lot of us in this field find so much value and interest in just the doing and the process and the how. And I so wanted to kind of motivate this talk, sort of thinking about the fact that, you know, people don't buy what you do, they buy why you do it. And so thinking about that as an organizing framework. And then I had to throw in like a nerdier version of the quote that wasn't a management science quote, but I love this one. And this is more I chose to aim it at students. I still like it. Highly competent people, you know, are always looking to keep learning. They do that by asking why. He who knows how will always have a job, but he who knows why will always be the boss. And I really like that Ben Franklin quote. So I'll keep going really quickly through this. Some of you guys already know me, but my career has been, you know, years of asking why, or trying to remember to ask why, with hopefully some learning how. And like Hugh said, you know, my background really took me from basic science to applied science. And that's sort of the other thread that I wanted to chat about. And, you know, we'll have lots of time for Q&A. So I would love to hear if any of the themes that I talk about are things that you all have found or seen in your own career paths. But you know, started out with biophysics. I will say that right now, that's awesome because my Facebook feed and Twitter feed is full of biophysicists and biochemists who are so excited about mRNA-based vaccine developments and sharing all sorts of super nerdy posts with me about, you know, Moderna and all the amazing work that's been happening. So that's really the background that I brought to quant finance, was coming up through a program thinking about really basic science approaches to trying to understand data, learn things from data, and answer interesting questions with data. From there, I went to StarMine, which some of you guys might be familiar with. StarMine, we built a lot of stock selection models. So that's really when I translated my kind of basic science background, and had been, you know, running MATLAB code to analyze fMRI outputs and try to think about where in the brain oxygen was being consumed. Went to StarMine, and there were a bunch of computational chemists who showed me how to, you know, use R instead of MATLAB because it was free, and use that to analyze equity stock returns data, and change that application. And you know, there also, I think a lot of learning how, but also sort of trying to realize that the why was really important as we thought about what types of models did our customers want? What were they trying to learn? And how were they interested in consuming our data? And actually that, I think one thing StarMine did that was really interesting was we built a bunch of stock selection models, but from day one, it was aimed at having consumers who could be either fundamental managers or quant managers. So we actually sold our equity stock selection models. If you were a quant, you would subscribe to potentially all 35,000 global equities that we covered. I did equity models. And you could get that every day, a score, 1 to 100 score for every company that we covered. Or if you were a fundamental manager, you subscribed and interacted with our models as sort of a dashboard screen, and you could look at them and they were clear box and you could look at the models that we created. So I thought that was a great place for me to think about how quantitative work can be consumed by quants. Quantitative work and output of models can also be consumed by non-quantitative and non-technical users, and how that second category can be really interesting. I've had that theme resurface for me way at the end of this curve at Fidelity, certainly. So StarMine got bought by Reuters. The same week Reuters announced they were merging with Thomson. I think they forgot that they bought us for at least a good, really glorious year in there, where we just hung out in San Francisco and kept doing our work. But eventually they realized that they had bought us, and eventually I relocated back to the East Coast and worked for Thomson Reuters out of the Boston office for a couple of years. And that's where I met John Fawcett, the founder of Quantopian. So that was, I think, January of 2013. He came and saw me give a talk on the short interest model that I had worked on and said, hey, I have this startup. We're going to democratize quant finance. Do you know how to write Python code? And I was like, I feel like I could probably pick it up. And went and joined Quantopian in later that summer. So they actually, in January of 2013, they were still in their seed round of financing. So they raised their A round that summer, and I joined them. And, maybe part of the story of Quantopian and some of the lessons that I learned there was, a couple. It's hard to find alpha. It's hard to scale quant strategies and overcome transaction costs, and overcome all the real world implementation details. And as a startup, it's extremely hard, I think, to do everything that you think would be really interesting to do all at once. I can maybe come back and talk more about that if folks have questions about that. But it was a great education. So at Quantopian, for those who might not be familiar with it, basically what we had was a sandbox of where you could come and bring your code basically to data online. So it was minute bar data for US equities at first. I think eventually we got some other data sets on there, but folks who had never had a quant background or done any quant modeling work could come and come to the data sandbox and initially run back tests using an open source back tester that we had developed. And all the open source work that we did at Quantopian, which really was a lot of software developers, less of the quants, that does all live on. So there's some pretty cool libraries that we wrote to do alpha research, to do back testing, to do data visualization, and even to do some cool sort of grid sorting, UI kind of things. That all lives on, which is great. And so, maybe I sort of saw that handwriting on the wall. Last summer, I moved over to join Mona Vernon, who had taken over Fidelity Labs, which, like Hugh said, is an innovation group inside of Fidelity. And at least one of my colleagues, I think, is on here tonight. So that's awesome. It's fun to be part of such a fantastic large organization where, it's a really big group of colleagues to get to know over, now been here a year plus. So Fidelity Labs, the goal is to be a spot within the firm where we've got, a real hybrid model and confluence of new folks coming in from outside the firm, along with veterans and people who've been at Fidelity for many years, like often 10, 20 plus years, sort of sitting together and working collaboratively on startup teams, thinking about fintech businesses for Fidelity to pursue. So that has been an absolute blast. Happy to answer questions about that also. All right, so what I wanted to sort of talk through today were how I have tried in my work to think about leveraging this advantage that I think I have of keeping basic and applied sciences and sort of the goals of both of those areas of discipline together as I think about my day-to-day work. And so I just wanted to like keep again, this really sort of high level. So, thinking about, well, what was the why? What's the why in basic science and what's the why in applied science? Keeping in mind that those two things are different. So basic science, what are we aiming to do? Like learn something new, actual original research. And importantly, it's okay. And I know my PhD advisor felt this. It's okay that you may or may not have readily observable applications, right? There are things that we learn in basic science where it's someone, 2 careers later who figures out an application for it. That is not true. And I, have been in the position of hiring data scientists now for a few years. And I sort of always try to bring up like, that is not actually true in the business world and in applied data science. There, it's great and it's interesting if you learn interesting and cool stuff, but really anybody only cares about it if it's the following is true, right? If what you learn can generate insights that often analysts and business users can translate into tangible business value. You can learn lots of cool stuff. And if it is not driving some type of business value, and there can be different time ranges over which that's true, if it's not fulfilling that, then your why, you need to look at your why really, really carefully. It's easy to say, it's hard to continue to really keep that in mind. So my experience has been that this is something that's iterative, and that I do see there continuing to be, more and more interplay and overlap, but you can't lose track of this apply it piece. So the business value has to be your reasoning. Now, you guys are mostly probably like a lot of quant finance practitioners. So you have a very clear and tangible relationship to your why and what the business value is of the research that you do. But if any of you are starting to venture into sort of more fintech or more data science that's going a little bit away from actually sort of trading on your alphas, you'll see that this is something that it is really worth reminding folks of. So some whys, right? So the one that I had was near and dear to my heart for a lot of my career was this first business value. So directly measurable investment returns, right? We're building models to learn about markets and make predictions that are profitable. That's a nice, clear why. Now, there can be a lot of reasons that your alphas don't line up with your results. And those turn out to be a lot of times, right? The devil is in the details, but it's pretty clear to know that's your why. But more and more I'm seeing as I've spent time in the sort of more, the broader fintech space, that there are these other whys, right? So driving sales of a product is a sort of pretty tangible why. One that you hear more and more, I think, sort of coming out of, maybe too overly simplistic to say Silicon Valley, but certainly coming out of more sort of new fintech or new, I guess new tech companies, I'll still give them the benefit of the doubt and call them new, is what I would call customer happiness. So where your why starts to get to be really a little bit more, I guess, sort of like aspirational, and cause you to really continue to think how to thread the needle of what is your model trying to predict? Is that going to cause this really difficult to predict thing happen? And I think that data scientists who can start to see places where they can build tools or get insights from data that will make people happier who are customers, I think that's a really exciting spot to think about, and bridges a lot of folks together to think about that. Some other whys. Now, this comes into, and I'm not going to go into sort of real specifics, but so some other whys: operating efficiency, speed to market, if you can do something faster, develop a technology faster, or engagement. When I was speaking to the kids at Harvard, and this was actually, I think, a week or two before the election, I made a comment that someone followed up and mentioned to me on LinkedIn that they liked it, where I just sort of casually said, data scientists have gotten pretty good at optimizing on user engagement, and it's probably the most dangerous aspect of our work. And we've maybe taken it a little bit too far and threatened democracy by becoming really, really good at optimizing user engagement. That's what I meant by that one. Just to quickly touch on something that I have seen since I've been at Fidelity, and not so much in my work at Labs, but as I've learned more about how data science is leveraged across the firm, this first one of sort of operating efficiency is one that I think is extremely, while it's a little bit unsexy, it's extremely promising and it's extremely tangible. And if we think back to, investment returns and alpha on the slide before, like, if you feel like, wow, you're banging your head against the wall trying to get alpha, and then you go try to make a process faster or better, or optimize the project I'm working around right now, we're thinking about some sort of sales engagement technology and trying to just make things faster and easier. These are really, I won't say low-hanging fruit, but it's doable, right? Improving efficiency of people's processes that haven't been automated or haven't had data science applied to them is a pretty fun place to work, because you can make real traction. So I wanted to sort of make a pitch for that being like a little bit of an underappreciated, I think, business value. So now maybe more into just a little bit of what I've learned stepping from pure quant finance into data science, and some modeling that I have thought is kind of cool, is, so now you know what your why is, right? Let's say for now, we're not looking to drive investment returns, but we're looking to drive either customer happiness, or maybe create a fintech data science application that's going to drive sales of a product. There's a bunch of things that I've seen pretty cool data science models being built for, and just touching on a couple, our next best action, product recommendation. That one's probably really familiar to everyone in sort of a Netflix recommender type style, or an Amazon recommender type style. Again, like maybe too efficient and effective. Certainly I am the victim of like accepting way too many product recommendations. And one that I've been thinking a lot about actually is probability of making a purchase, which is a little bit different. Next best action. I don't know if anyone on the call has worked with any of these kind of models, but it's pretty interesting. So the thought there is that you can get a bunch of data surrounding basically like a sales pipeline. And so you can look at how customers flow through a sales acquisition process. How are they identified? What are the milestones that they proceed along, and when they make a purchase? And if you can do that and sort of characterize by data that you get access to kind of where your customers are, then you can give really smart tools to your sales force to know, well, what should they do? So examples of what your next best action could be is, you should call Bob, or you should email Bob, or you should email Bob at 10:30 a.m. and your subject line should be this, and the banner on the email should be this color. And by the way, the picture should be this. Not inside Fidelity, but I've had a chance to work with one startup recently who's they're doing some very cool, I think it's very cool work with basically personality modeling and developing like high dimensional personality fingerprints for consumers. Now, there's also, there's a real slippery slope in all this fintech and sort of data science work, where there's a lot of privacy concerns, but putting this aside for a moment, what this company has done is basically leverage looking at consumer behavior data to develop sort of 100+ dimensional personality models of, I don't know, call it like 260 million US American consumers. And so then if that person flows through a pipeline and you want to say, well, what kind of ad should I show them? Maybe I should show Jess an ad for like this Patagonia jacket because, not necessarily because last week I bought another Patagonia jacket, but because they've categorized me as someone who is outdoorsy, right? And so they're going to show me all sorts of outdoorsy stuff. And that's an overly simple example. These personality models are crazy, really crazy. In fact, actually, for one fun, if you want to go away and look at it, and maybe everyone has seen this, it's called Apply Magic Sauce. If you go to applymagicsauce.com, you can test their personality fingerprinting, and it is freaky. You can drop in if you're very privacy oriented, do not drop in all your LinkedIn content, which they will let you do, and they will save it for research. But you can just drop in your LinkedIn bio, or you can drop in a piece of text that you wrote, and they will give you a personality profile, and they will also guess how old you are. It's really creepy. Probability of a purchase is one that I have been working on. So I'll keep that sort of high level, but I think this one is pretty interesting in that I have found there to be a lot of analogies with stuff that I learned and thought about from sort of quant modeling, where I've tried to bring some of these simple concepts of making relativistic predictions in terms of purchases. So if there's a cohort of folks I'm trying to figure out are going to take some action, whether it's a purchase or some other action, I think you can kind of think of those as a bunch of stocks that you're trying to predict whether they're going to go up or down the next day, and you have a bunch of data that might lead you to believe that they will or they won't, and it can be pretty tricky to predict exactly who's going to do something like buy a financial product or pay for a financial service. Whereas if you've got a whole cohort of folks and you're trying to sort them on their relative probability of doing something, I found that to already kind of show some pretty interesting promise and be an interesting area to work. All right, so here's probably again, you guys I think I'm probably speaking to an audience where these are all things you guys are really familiar with, but if there's anyone who's earlier in their career, maybe needs to hear this, then the next really important step, right, once you've identified your why statement and you know what insight your model is actually aimed at generating, can your business users understand and capitalize on the insights that your model is generating? So again, if you're a quant building alphas, who cares? Because they're going to get fed into your portfolio construction, your optimization, and you're just checking your P&L. So that's great. It's really simple. Your insights can be utilized. But if you're at a fintech or you're a data scientist trying to think about how to help a startup, then your insights might be being consumed by a non-technical group of users, or you might just need to be able to explain them. So do they make sense? Do they offer some real value? And are they easy to use? So it's a little bit overgeneral, but I think that if you have worked on models, you will probably be able to look and ask yourself those questions. And when you can answer yes to all three of those, you'll find adoption much easier. That's another thing I've seen inside Fidelity is there's a lot of great data science work, and the places where it is most successful are not necessarily the places where the error term is the smallest or the prediction is the most perfect, but the place where the downstream user really understands and can leverage and easily utilize that insight or that prediction, that's where you get traction. Especially a lot of the systems folks are building nowadays, think back to some of those business values. Everyone is excited about trying to use learning models to create sort of self-reinforcing, improving quality predictions. And one thing I've seen very clearly is, okay, great, you got a learning model, who's teaching it? So you've identified your training data, you've initially trained your model, but a lot of these systems, you really need the user to continue to engage with it and be sort of either implicitly or explicitly providing some feedback. So imagine a system, like I mentioned, with a kind of sales engagement that's a next best action and tells the salesperson, hey, call Bob at 10 a.m. You then need something that either is well instrumented to check if Bob's sales metrics go up after Bob is using your, AI model, or you need a way, when this is a lot of times what people do is before they can get that might take a lot of time and data to accumulate. They want Bob to see the next best action and then go in and say like, dear AI, I took that next best action and it worked great, or, it didn't work so great, or I thought this, and how you instrument that feedback loop and whether you make it natural or onerous on the human that's in that learning loop. I have seen that already, that there are places where that is sort of done really well and it's really natural, and that's a really great value creation loop. And then I think I've seen some places where it looks like there's a pretty cool model, but it's sitting over on the side of the analyst or the salesperson's desk, and they're not sure like exactly how to use it. And so you're almost set up like a weird system where, reporting structure wise, people have told them like, you need to use the AI bot's recommendation, and then like you almost have to go and click this button to say like dismiss it, or I don't want to do that, and you create like almost an adversarial relationship between the human and the robot, and the human's like, I don't want to train this dumb robot. So I've seen that be an interesting challenge. All right, so maybe I've made that sound easy, maybe not. What are more fun ways that this can go off the rails? These are all things that I have personally struggled with in my own career. So maybe I'll share them to make some of you guys feel better. But in no particular order, data, and data is obviously both, our reason for being and our best friend and our worst enemy. But that's not going away in the bright, shiny future of machine learning and AI. If anything, we've just cast the net that much wider and made our own problems that much worse, with processing, dealing with, normalizing, understanding all of this data. And I didn't even think of it really when I put this slide together, but one thing I'm continuing to see more and more is I still think we're really right at the beginning of sort of the data privacy. I don't know if it's going to be a sea change. I kind of think it is, but the regulatory environment and the way that folks are going to think about storing at least user data. We're thinking about a data-based project right now in labs, and we've already started to learn the variability across state by state of how you're allowed to work with user data. So California has one set of standards, Vermont has another set of standards, other states have other standards. So that's something that was not ever something I considered in quant finance land, of sort of where did this data come from. We did talk a lot. I know there were points where I remember when I was at Quantopian, we spent some time working with colleagues down at Point 72, and they were, interestingly, and so they were like really nervous about provenance of data and wanting to make sure that they could sort of say this was all, data that was not MNPI, right? And that is one version of it. But now over in like fintech data science land, or sort of where you're trying to use user data to make your product smarter and smarter, I think that's going to like continue to just explode as a more and more challenging place, opportunity and challenging place as people change that. Then, communication. So another place I see things really go horribly awry is, lack of ability to speak the same language between the data scientists and the business users. That is a big challenge. Again, traditional quant finance, if you talk to anybody, or if you do, they all went through similar grad programs. You're all very comfortable speaking the same language. Maybe you're fighting with the traders, but you can sort of probably just get around that. But in the land of fintech, you got to talk to your product manager. You got to talk to your UI designer. You got to talk to the business owners. You sometimes have to talk to the board. And being able to really communicate really, really simply about why you're doing what you're doing and why it's important is really paramount. Another one that I guess I see already at Fidelity, or one of the core values, is pace over perfection, which is awesome. And I wrote it here, but I think there's a reason that they feel the need to sort of list that as one of their core values, and keep saying it is, it's really tough to do things super carefully, conservatively, and quickly all at the same time. And so maybe in just the context of sort of data science, I think that a lot of times I'll see folks really wanting to continue to improve the quality of their prediction when they haven't yet kind of gone and completed a loop out to maybe, let's say, like the customer, and said, well, does customer even want this? Like, do they even want to buy your model? If your model is like 60% accurate, is it useful in this business value? And if it's not, will it be more valuable if it's more accurate, or is it just good enough? And the next model that you build on some other aspect of your product, would that be more valuable? 60% is good enough. And so sort of knowing when enough is enough. Then you guys will all mostly know that predictions are hard, especially about the future. So I find that I think there are a lot of places that it's really like natural for people to want to try to make time series predictions, or just make like future temporal predictions. And I am always trying to steer folks when there's an opportunity to make cross person inferences in the same time unit, that those are, I think, easier. So clustering people and seeing like groups of people who behave like this right now, that nearest neighbor will probably behave similarly. Those, I think, in my experience, tend to be lower hanging fruit than, example of something that people have talked about, with me about really, really wanting to model is like, when are people going to have life events? So when is someone going to get a job promotion, get fired, get married, get divorced? And maybe Amazon is good at predicting those. I think it takes a ton of data, and predicting those sort of time series things, down to a timeline where it's really relevant, are really challenging. And then, back to the one I've been hammering on all along. I just think we're all really prone sometimes to getting nerd sniped, which is the XKCD cartoon version of where you're just so fascinated by the very nature of your problem and really understanding it deeply, that it can be tempting to continue to work on what are you optimizing on? So is your next day best spent like improving and decreasing the error term of your model, or is it best spent on communicating that value that you've already got and making sure that it is valuable to your business users? And in my experience, usually it's sort of good to ship your code, put your model in production, and go talk to somebody about it. And I always try to encourage folks to build the simplest possible model first and check if anyone cares. So then the last thing, and I won't drag you through all of these, is just thinking about applying principles and skills from basic science to data science. So that's where, again, this slide came out of, kind of talking to data scientists, and again, I don't know if we might have some sort of real folks who would label themselves sort of data scientists first and quant second, or maybe mainly data scientists, but their data science is a really hot field. Folks are getting paid really well who are data scientists, and some of them have strong academic science backgrounds or basic science backgrounds, and some of them really come out of computer science, no offense to them, but sometimes they didn't come up through a basic science tradition of thinking about some of these basic science tenets. Extraordinary claims require extraordinary evidence, right? Trying to come up with hypothesis-driven research where you can sort of prove the inverse or falsify your work. Always develop Occam's razor simplicity. I mean, I have worked with a lot of data scientists, especially recently, and I think they're really sick of me saying, okay, that's a great XGBoost model or whatever, but can you just do like a histogram of your data or a scatter plot of your data? Or have you just tried a linear model, and like, what's the marginal value add of your learning model over something else? And usually it will show them like, yeah, my learned model is better. It's a lot more complex, right? And so sort of thinking about those trade-offs, and replicability, ruling out other things that might be the reason that you're finding what you're finding. And, obviously our favorite, I think it's a good one to end on, correlation versus causation. And I'll say I noticed I was joking to Hugh earlier that I had taken Twitter off my phone for a really long time for my mental health, but I just put it back on. And I noticed that the spurious correlations guy, Tyler, whatever his name is, had just tweeted that his site was down, and it was code that he wrote when he was like 18 that he was having to rewrite that had broken. So that's my plug for spurious correlations. And now I think I didn't even leave as much time for Q&A as I'd hoped to. So with that, I will pause. I didn't talk that much about optimizing on happiness, but I am leaving you guys with two, I think, kind of fun links that are a little more business minded. The Simon Sinek TED Talk, if you haven't seen it, and then Tony Hsieh's book, Delivering Happiness, which talks about how he built Zappos, which is basically a big algorithm to optimize on customer happiness. It's a great book if you haven't read it. All right, I'm going to stop there and see if there are questions.
Jessica, there's so many good things you said. I've got like a handful of notes that I've never done at a coffee before, and I'm just like, I don't even know where to start. But one thing is, I'm curious about where you're working on now compared to the other firms. What is Fidelity Labs like? I mean, who's in there? Who are they hiring? What are you hiring? What are you doing?
Yeah, great question. So Mona, who hired me, we had overlapped at Thomson Reuters. She ran an innovation group inside of Thomson Reuters, where she did a lot of data science stuff there, but actually at Thomson Reuters, she was more on the side of the business that dealt with legal. And so she's really focused on thinking about, again, like I mentioned, sort of how to think about and build fintech businesses for Fidelity. That is a very ambitious challenge. So Fidelity is a fantastic firm that is extremely well optimized on, creating investment products and selling investment products, and largely directly selling investment products to retail investors. So I think it's really exciting that the firm is behind the idea of other monetization models. But it also means you're inside of a big firm that is like operating at such high scale that I think it's going to be interesting to think about creating these startup ideas, and sort of like what's 0 to 1 look like, and how big is big enough for it to become interesting. We're pretty early in that. Mona's team has got, again, like I said, so there's some outside folks. We're just starting to hire some data scientists. I have an open role for a data science position for principal data scientist. So we're just starting to hire some data scientists. We started with sort of teams of a managing director, a product lead, a design lead, and an engineering lead. So a couple folks from Quantopian have joined me actually in labs, which has been awesome. And yeah, we're just sort of trying to, fuse our outside minds with the inside minds who understand how to get things done at Fidelity. And that has been pretty fun so far.
Sounds really like an interesting group, an interesting prospect. So,
Jessica, I have a Fidelity account. Is there a tab for the lab?
There's oh God, don't even ask me. But there's a Fidelity Labs website. I think, unless I don't think they took it down. They just asked me for my picture to put on it.
I think that the current one, the Fidelity Labs one, I think they just decommissioned it, and they might be building up a new one. But yeah,
I think that's right. Yeah. So you may not find it right now, but they asked me for my picture to put on a website. So maybe there will be a website coming. I think that sounds right. Again, it's a pretty Labs hasn't had an external facing, that much of an external facing brand. It's really been more of an internal innovation unit, but it has been around for over 15 years, actually. So it's not, Mona is new. Mona is a new leader of Labs, but it was created by the previous chairman, really to be a spot for people to experiment and, sit outside the broker dealer and sit outside the traditional business units and have a little more flexibility. So it's been around as an innovation group for a long time.
Thank you.
So have the products that have come out of the lab at all correspond to the principles that you were just talking about? And that's amazing that you said it's been around that long. That's really surprising.
I don't know. I mean, so what I think has happened is it's ended up when Mona came in, I think the prior, at least sort of look back 5 years, there had been a lot of focus on innovation for sort of consumer facing stuff. And so I think what would happen is they would work on an idea. There was one around sort of goal-based savings. That was a recent one. Okay, good. Jillian's going to keep me honest because she knows, I'm sure, like more than me. So there was a sort of goals-based savings app. And what has happened is when things do well, the tendency to say, well, now it's big enough and good enough and important enough to go sit inside of a business unit, has sort of absorbed teams into business units. And so you wouldn't necessarily see, like a Fidelity Labs sort of spun out product or separately branded thing. Now, I think, it's going to be interesting to see kind of where we take the projects we're working on now, but we're kind of continuing to get the directive to really try to maybe incubate things a little bit longer. And so we've been starting to think about, but I think it's really challenging, and we'll see, have me back in a year and ask me then about kind of go to market, right? And again, sort of, for any innovation group, I think it's one of these challenges is sort of like you're inside of a big organization that has a lot of leverage and advantages in certain areas, and that might be go to market or distribution. But when you're going to go create sort of a new type of product sold in a new way, how much do you leverage that's sort of your advantage of being in this big company, and how much do you try to kind of stick it out, put up your new website? Now, one, I'll tell you, I think that the website is up, is there's a project in labs around that actually is more kind of quanti a little bit. It's an ESG based portfolio analytics. So it's called ESG Pro, and I think it has a public facing website. And so there, it's quite cool. The idea is that financial advisors are like, investors want to think about and give ESG based investing, and advisors want to offer those services, but they don't know how to sort of how to actually implement them. So the investor wants something the advisor doesn't feel all that comfortable talking about. And so that's one project that's been in the labs. It's a bit ahead of the one that I'm working on in terms of just a little bit further along with their concept.
Yeah, it's a really timely topic. I mean, I forget how many trillions of dollars now that people have been poo-pooing ESG for years, and now it seems to have like gotten amazing.
Yeah, and this is an approach which, I don't know. I mean, I know in quant world, and we worked on this at StarMine. I think we spent a lot of time trying to decide if we thought ESG was an alpha factor or not. Yeah. And maybe we sort of missed out on the concept that, well, whether it is or it isn't, there's market pressure that's going to flow funds to things that have an ESG label on them. So it's like a little bit more of a organic aisle kind of phenomenon. And then I think now you have folks scrambling and saying, oh crap, people are just running through the organic aisle buying stuff, and there's no real standard on like what's it say on the label and what's labeled organic. And so can you try to build tools to help investors know whether they're getting this ESG product? Although, I'm not an expert at all in this, but it does seem to me like one of the challenges, and I don't have any inside track knowledge on this, is just sort of who's going to really become that standards bearer for how you're measuring, these factors, because that's become a cottage industry in and of itself, right? Sort of who's measuring the E and the S and the G, and what does it mean? And when that's still kind of subjective, it's really tough, I think, for investors and advisors to sort of, know. But the concept with ESG Pro would be, the advisor would go and say, hey, here are my typical model portfolios, right? So my 60-40, my whatever, okay? And this is what I know. I've evaluated these managers, I've selected this lineup, but now, Jess comes in and she doesn't want to support whatever issues X, Y, and Z. So how can I tilt my model portfolio that I'm comfortable with, but yet give Jess what she wants? And so they've tried to go through, and I think it's that one I think is going to sit under the Fidelity Wealth Advisory Services. There may be some, acronym for that, but where it's going to become an investment advisor, and they're actually going to be able to say, hey, yeah, we can pull Fidelity thought leadership, and we can basically tell you, here's a good replacement, either instrument by instrument replacement or just sort of another model portfolio that would have the same risk return characteristics of the one you are comfortable with, but have these tilts. Now that's not trivial, but I think they are following market demand.
Yeah, that's
that.
really speaking to exactly what you were saying. You know, there were a lot of, I mean, everybody is trying to produce the data now. I mean, MSC, all the big data people are producing it, and yet there's still people that are doubting it and wondering it. But at the same time, you're right. I keep hearing clients want this. What do I say to them? And that's what the managers, they don't have any idea what to say. So
yeah, the clients want it. I mean, that's the thing at the end of the day. Actually, so my boss who
Yeah.
hired me to Starmine, Stephen Malinak, was at True Value Labs, and they just got bought by FactSet. So it's an active, active deal space. And I thought it was cool when he went there. I was like, you're okay. You care about ESG. That's great. Good for you. But I think it was a good choice because I don't know. I don't know the terms of that deal, but I thought that was interesting that they got bought.
Yeah.
At what level of the stack is that customizable? I know
the ESG Pro thing.
Yeah.
The one. Okay, so like in theory, it's really customizable. Actually, like it is the way they built it, but the advisors don't care, unfortunately. So they spent a bunch of time making it be like a tool for, I think, for really sophisticated advice. Well, like you, Eric, right, might actually like what they have built. But then over time, they just found that now remember, because they're selling this to financial advisors, okay? So over time, again, no offense to financial advisors, these guys were like, just give me the answer. Can't you just give me like 3 options? And this guy, Nick Bernetti, who had been a quant in the SAI part of Fidelity. So he and I were sitting there and he's like, I've got these tilts and he's got these full, he was using, I don't remember, a real optimizer, and really running this, like you could just go in there and, effectively you could be in the pilot, you could just like sit there with Nick Bernetti and like do a completely custom optimized portfolio for you. But then I was like, but diversified revenue, like we're gonna sell this as like a software model. And so it's kind of, I think the thing they're going to go to market with is going to be a little bit less customizable, but that's kind of just following what the advisors kind of want. I don't know. I don't know whether eventually, or, maybe it's more of like an institutional tool, to offer something that's like a really smart ESG, like really customizable ESG optimizer kind of thing. But that's sort of what he had originally built. That was like the lab concept that was in there was, that you could really get pretty sophisticated with it.
Yeah, but the clients are going to say, yeah, this sounds great, but I want something, they need something very simple. They need education. So how much of a role do you think that plays in the lab?
Yes. So I think there was, I spent my time talking to the quant guy about how he was doing it, but that, 9/10 of the team was working on like the UI and the language that they were wrapping around, sort of explaining it. Yeah. Maybe the only other thing I'll share that I've chatted with, I spent a lot of time talking about this with Mike Evan, who's a friend of mine who cares a lot about ESG. He would run Numeric. Some of you may know him. And we've been talking about, and we've been talking about this challenge that folks find where, if you run it like an optimization problem, you wind up with these like really interesting moral quandaries of like, oh, okay, so, if I'm willing to have like one more woman on the board, but like sell this many more guns or put this much more drugs into like, there's these really interesting, like if you have this n-dimensional space, like that's basically, what you're doing is sort of having these weird perverse trade-offs, and folks don't like thinking about it that way. And then the worst part was he was saying he thinks companies are starting to think about it that way and game the system. So be like, well, we could like buy these carbon offsets, or we could put someone who's diverse on our board, and that's like equivalently will move in the, Sustainalytics space, in the same manner. So I don't have any useful thought on like how you handle that at all, but just that more once you start measuring things, then folks, like think of it like, an analyst model, right? Or something, you start measuring things and folks start thinking about how to game those things that you measure. I think that's another interesting area.
CVS still sells OxyContin, but they don't sell cigarettes.
Well, I think we've had people in Aquafew who've dealt with the level versus change problem. And the change seems like an alpha thing, but the only way you're going to get the change is if you start from way below. And so an incremental improvement is you're moving towards the good guys, but you start as somebody with a lot of hair on there.
Well, I mean, gosh, I think that's why you still have got like all these oil companies show up like right near the top of a lot of these things. And they're like, well, look at how much money they're spending on innovating to improve, you know, the impact. And it's like, well, yeah, because they are the, yeah, I think that's an interesting problem. I don't know if that's a problem that gets solved, you know, with quantitative tools, or like we said, with, you know, sort of, policy, or, you know, or maybe it's education, you know, maybe it's continued investor education, but at least the investors are asking the right questions. So I find that encouraging. So that was back to, you know, that was a really long answer of what are we doing in labs, but that one's a good example, actually, that I think we're proud of, and we're excited to see that one come out in the real world.
Yes, you know, one problem I've had with the younger, I mean, I've been mentoring a couple of the young computer science guys and data science people, now they're calling them, and they are really good, but they don't understand anything really about what they're doing. You know, it's just astounding, and yet they'll come up with these excellent machines. You know, I remember one of the Quaffaview examples. One of our good friends there said he was in a Kaggle, and there was a competition, and these 3 kids from MIT came in, and they had 20 different models that all came up with anything. They couldn't explain anything about what happened. And he looked at the data and he said, I can tell you exactly what is involved in 2 lines of code. And so how do we, what do we have to do to teach the data science? We need some cross-discipline training here or something to get these guys to understand what's going on. What do you think?
Yeah, you know, I am a little bit of so I think that there are more places than I was sort of willing to admit, maybe, you know, 5 years ago, where like you can just brute force and sort of throw a bunch of models and just like get 2 answers, right? So I think there's like certain applications that lend themselves well to just giving up on like a fundamental understanding. But I don't think that, but yet what are areas that are not like that? I don't think you can run investments that way, because I think you're really accountable. Like, so I think there's maybe this space of like, what's the cost of being wrong? And what's the cost of being wrong in a way you can't explain you were wrong? And so I think that a lot of advances have been made with, you know, I don't know, like basically a lot of image recognition, like video processing and sort of like scraping and searching and matching things. Like there've been faster advances than I would have thought we would have. And maybe it's, you know, whether it's spoken language or it's images, but things where the properties are, you know, I mean, this is like a very well understood criticism right now, but things where there's, you don't have this non-stationarity problem, right? Where it's sort of like, if you can count on the relationships in the data persisting, then maybe it's like less of a big deal why those relationships are there. Now, that doesn't mean it's still like intellectually satisfying, I don't think. But if it's sort of like, well, you know, I've labeled this picture a cat and as opposed to a zebra, but no one cares, and then there's enough data and it's okay, you get such a benefit of just throwing every different model at it and like learning things. Whereas I just think there's applications where we can't get away with that. And I think, you know, investment space is one, both because it's not an acceptable level, you can't explain it to investors, and you don't have that stationarity, you have the non-stationarity issue. So I think it's a matter of where. But then separately, I'd say it's really sloppy to, you need to know when you're choosing to throw up your hands and say, I'm giving up on having a fundamental understanding, I'm just going to like look at what's in here. And I think the problem is that you've got folks who are just applying that second school of thought all the time and not able to. So I had an example, and I'll anonymize them so you won't know there, but I'm talking to these folks that I was working with, and same thing. So we have a set of data, like not that exciting, but it's even like public data. So we're looking at this public, like financial wellness survey data. And it was a really simple thing that they had looked at. We were trying to just sort of prove a bunch of baseline statements. And it was like, you know, one of the baseline statements was like, you know, men buy financial advice more than women. And I was like, okay, well, whatever, fine. And they're like, oh yes, we proved that. We looked in the data and that was true. You know, 846 of the men did and 452 of the women did. who said they bought financial advice. People said they bought financial advice. This many were men, this many were women, and it was more men than women. And I was like, well, okay, but what about the other people? Oh, also more men than women who didn't buy financial advice. There's just more men than women in the sample. And you like throw the bar charts at each other and you're like, oh my God. And I was like talking to these guys, and again, they have like advanced degrees and their job title is data scientist, and we are like paying them for that work. And I was like, but it's not like, you know, and just, I left the session and I was like, I don't even know what are the right words to use to explain that, you know, that is not a thing. And there were smart folks, and eventually they figured out like what I was saying, but they had not, you know, they had thrown the machine learning model and the deep learning model at it first,
Yep.
as opposed to the bar chart or the scatter plot. And you know, maybe we're all getting old and irrelevant, but I can't, you know, I just think that's really problematic, because you kind of get this real false sense of security when you have like all these, well, here's my precision and my recall and my this and that statistic. And you're like, okay, I don't know, these are all about 60%. Like, what does that even mean? I think that, to me, that's a little bit of, you know, do you have that foundation in basic research? And so I still continue to have a little bit of a bias in data science hiring myself. Like I said, I have a position open now. And I thought really hard about whether I really wanted to look for folks who had graduate degrees in like a quantitative field, or didn't think that was necessary. And I decided, well, I want to talk to sort of both flavors, but I just find that people who had to go through that basic science path and really sort of think through, you know, that why a bit more, I tend to find them to be a little faster at catching their own silly mistakes or modeling issues, or sort of going back and really wanting to sort of understand that why. So I guess, you know, that's kind of where I would, kind of what my concept was thinking about this idea.
Yeah. Well, Sri and Quant University are trying to do their best to help us get good data scientists and understand our field as well. So put a pitch in.
I'm just kind of listening, Jess. I mean, these are like the problems we deal with on a daily basis, right? So, you know, we have like the folks who want to throw deep learning first at the data.
Yeah.
Because it's cool, right? I mean, like, you know, you always want the shiny thing first. And, you know, I have had students, I mean, like, you know, not to kind of, you know, take away their enthusiasm. It's just that you have so much noise out there proclaiming that all these cool technologies can do magic without the mass of all the problems being solved. You have so many niche use cases wherein you look at it and say, oh, this is amazing. You can do all these cool things. Let's throw it at our problem. Doesn't work.
Yeah.
Oh, maybe the data was wrong. Let's try and, you know, massage the data. Maybe the model is going to work. So you get frustrated when the shiny object doesn't work with your data, right? And, you know, you throw a simple regression problem, and, you know, and then you say, oh, the simple regression equation does better. Why? I mean, like, there's no question, you know, some simplistic models, the parsimony, the basic statistics you think about, you don't start there. You always start out with, I want to have the coolest thing out there. And I mean,
yeah, I would like there to be some sort of like okay, you get a budget, right? You get a budget, you know, every month in your research, and, you know, it costs X to run your, you know, machine learning model, and it costs like $1 to run your linear regression, right? And you can only spend so much money every month. Because I agree, I had these, again, great, really smart folks come to me, and they were like, hey, guess what? There's this Google thing where, and this is cool, but it like will augment your data, right? So one of our problems is, oh, you'll be like, well, we don't have enough data. And so we were looking at something where we were looking at text, and we were trying to, so I mentioned this like personality idea. So we were doing something around that. Like, if I see what you wrote, and so we didn't have enough text, and they're like, oh, there's this really cool thing. I forget now what it's called, but basically developed by Google, where you take a big corpus of text and you use Google Translate to translate it into French and then back. So Eric knows what I'm talking about. And there's some like way you can do it where you basically like, kind of like you introduce, it's smart, right? You introduce like jitter, like basically machine noise. And I guess the idea is like that machine noise like introduces variability in your system, but it doesn't like skew your data. And so to an ML model, it looks like you just properly have more data. But like, was that really the first thing we needed to be trying? Like I was just like, this is cool, but you know, I don't know if this was like what we needed, you know, right at this moment. But it was cool. It was cool. I can't like get away. So I don't know if you think that works. That seems like that's a quanti application, actually. I mean, because folks are trying to do a lot of NLP. So you know, I don't know if that's something that people are actually using or not. I haven't done a ton of NLP in the quant space, but that did seem like it was. Again, I don't think we needed to do it. It was cool, and the data scientists were really excited about playing with it.
I think my biggest question, and this is just a question in general for everybody, is how much of all this research makes it into production, right? You know, there are so many cool ideas which quants work on, but how generic are those wherein you actually deploy them into production and allocate, you know, money to these strategies? And many times we kind of just work on things and they kind of fall aside, or if they go in as decision support systems. Like the NLP is a classic use case, right? Wherein you have so many cool innovations happening, like summarizations, ways in which you can categorize search, look for various entities and all the cool things. So you build these amazing decision support systems, but still humans are getting all these cool tools to make better decisions rather than the machines themselves getting smarter. So that's a big question on how much of it is like automation and, you know, decision science and data science just getting into production without human involvement, or are we just kind of building tools to make our lives better and we don't have to sift through all the information ourselves and let the machines do it for us?
Yeah. Well, you has got a company. Well, he used to be doing some work with that does an amazing amount on language processing. I mean, you know, they take a very interesting approach to it, which is they don't care what it's written in. You know, that's always shocked me. It's like, well, I thought words were pictures, but no, they look at it completely differently. And you know, I haven't really understood it, but they can take Japanese or, you know, Chinese or any other, you know, the Middle Eastern scripts, the Islamic scripts, and they can parse the data out of the text. It's just astounding. I mean,
I think that was Bob Mercer's fundamental innovation. Right, he was the guy who came up with this sequence of ASCII numbers comes after that one, and that leads to machine translation, and that was the basis on which Google Translation got formed and like really advanced a lot. But he did it for Renaissance before he did it for Google.
All right.
Right.
And now he's funding, you know, crazy right-wing social networks.
So where did we really end up? Yeah, I was going to say one of the applications that totally seems like it works, and I think within Fidelity I've seen it deployed is like the chatbot kind of stuff, right? So you know, like that just does work. You know, I mean it. And so there's a lot, like when I said operating efficiency, right? Fidelity runs like, you know, God knows how many call centers. And so like whoever set up, I have a Fidelity account. So, you know, maybe you've got a ton of money in there, great. If you don't, then you're fine. We're okay with you. But if you call our call center once, you become a loss, I believe, right? It's amazing what the dollar value is of a customer to Fidelity, below which, if you utilize a human support resource, you become, you know, a cost on the system. It's amazing. You know, I don't have the numbers at my fingertips, but I know when I came and sort of explained to me some of these things, I was like, wow, that's bonkers. And like partly that's on us and our cost structure of like how, you know, the call center model had worked. And obviously like that's changed over time. But so if you can route a call better or replace a call with a chat bot where you save some percent, like it's amazing how accretive, you know, I don't know, accretive to the bottom line, but how much that impacts the bottom line if you can use some of these technologies to just save time.
And that becomes data for Fidelity. So if you look at it that way, it's a cost to give it, but it's a data that they can now use to train their algorithms to learn. like at the end, was this useful? You know, that question. I've always hit that one and go, yeah, sometimes.
Some of them.
That's an amazing area, right? I mean, like I'm teaching the last few semesters, I've taught this new course called the algorithmic marketing course, and just I was listening to, you know, all the cool things like the next best action models. You know, we kind of try to teach those kinds of things now.
Yeah, Jess was mentioning those things. Yeah, exactly.
And one of the models we've kind of worked on is this notion of CLV, the customer lifetime value, right? So it's the expected value of a customer over the customer's lifetime, and you discount it to today's thing, and you put a number, and you say, well, what have you done with the relationship with the company? And if you've always been returning products, if you've always been asking for discounts, you've been only using coupons when you buy stuff, so you are a loss. You're a liability for the company, and you get involved only when it's beneficial for you, and you're not going to make the money. So what companies are doing nowadays is incorporating the CLV model with customer service. So when you call, you basically, the customer service representative has this number flashing at you on what your CLV is, and it'll also give you the next best action. So if you return, if Larry calls, Larry's been a great customer. Unfortunately, the product broke and it's beyond 30 days of return, but Larry's expected lifetime value is $1 million. So here's a new toaster for you, Larry. Don't even bother sending it back. But if I call, say, well, Shri, you've been like returning bookshelves and paper shipment, and you got to return it in your own dime. Otherwise, we're not going to take it back. And by the way, you can only use this service from next time onwards, or we will charge you, kind of a thing. So it's becoming so dynamic on how much we can kind of estimate based on your behaviors and based on your actions, right? Wow. And also I'm seeing all these like predictive modeling, right? Wherein I think just was mentioning. So you are at a particular portfolio level, and something happens. Either there's inflow, or you're kind of getting beyond that limit, and you're getting to the next layer. So you don't want to wait till the next layer hits before you engage your financial advisor to call you. So you immediately get these leads out to the financial advisors, wherein they just make this soft contact saying, hey, by the way, I live in Newton too. I realize that you're in Wellesley. So I just wanted to say hi. How are things going? And it's like, never heard from anybody, financial advisor.
That's totally right.
And then they'll kind of get to make a soft introduction and wait for that bump to hit. And congratulations, you made it to this level. So I'm going to be your personal advisor from now on. How about we chat, kind of a thing. So all these, marketing is getting embedded into all our, at least in the retail workflows based on data science, because you are providing so much data based on interactions, and everything's being tracked. How many times do you check your portfolio? How many times do what happens if you encounter a significant loss in your portfolio, and then you immediately get a call from or an email from your financial advisor saying, hey, by the way, have you thought about portfolio management? Do you think one of us can help you? So all those are marketing workflows, which is all data science based.
If you want that taken to the nth degree, talk to one of our counterparts in insurance. They have now these trackers that tell you that they're only tracking your speed, your distance to braking, your frequency of passing other people. There's GPS in there, and they know when you stop at bars or liquor stores or places that are far away from your house. And the degree to which insurance is driven by those kind of costs and eliminating the far tails is just incredible.
Well, the personality prediction company that I mentioned, it's called Pinpoint.ai. I don't know if you've come across. Do you know them?
No, I haven't.
Okay, so their biggest, a customer base with whom they are getting traction is insurance companies. Sure. And so basically, again, because it's this intersection of your digital footprint, basically, and then predictions about your subsequent behavior. And so they've said that they could basically help these insurance companies save money by pre-telling them for a given pool of customers who's likely to be sort of the most expensive customers. So who's likely to file a fraudulent claim on their home insurance policy or car insurance policy. It's crazy. But those are, so those are some real applications. And again, the thing I'd say there that I'm getting increasingly educated on is that I think that the data privacy aspect and the GDPR aspect is going to be right in there in terms of, companies figuring out how to, frankly, kind of circumvent those issues. And what I think it's a little bit the old trick of, this is just derived data, Morningstar. I'm not sharing the raw data. These are my star mine derived values. Is that folks are then saying, oh, okay, well, here's just predictions. Like, here's just this like n-dimensional score about a cluster of people. And so you can sort of try to get around some of these data privacy things by, clustering people into groups, right, is like one nice trick. And then the other one is by basically, again, projecting into some n-dimensional space where you may not say, oh, this dimension is like cigarette purchases. Well, fine. But it doesn't matter at the end of the day if you're just feeding that signature into a model that's predicting, whether they should give you the Apple credit card or not, right? I mean, that kind of thing. So I think it's going to continue to be a really interesting space.
So it's kind of interesting you mentioned insurance, just because two use cases. One of my students was actually interning at a company not to be named. And one of their use cases was they were trying to predict insurance based on roof types of homes. And they did not have the data. And then they were able to like get satellite imagery of different roof types. And then they built a deep learning model which can identify different roof types. And they created a whole new data set. So you provide the geolocation of a home. This lookup service is going to give up the roof type. And that's important information if you live in a hurricane-prone area, or if you live close to the ocean. And, people, like if you look at the regular information of your home, people don't really disclose roof types. And that's, there's no way you can go in and survey people or even estimate those kinds of things. Right. So that was pretty cool. This was like a 23-year-old graduate student just basically getting data and he coming in saying, can I do this for my final project? And say, cool. And they basically got a whole new alternative data source, which they're now marketing because of an internship. Right? So that was one example. And the clustering example you mentioned, I think we're doing some area work in terms of masking and anonymization of the data. So the whole notion of, how much data can be used to actually train models is becoming more and more concerning, because even from taking like customer data and then kind of giving it to the machine learning folks, you're already breaching, and you can like reveal personalities, you can reveal identity information. So that whole notion of building out a model and then kind of looking at all the possibilities and then generating synthetic data. So when you look at the statistical properties of the data, so they look the same. So from a machine learning model's perspective, you're providing the variety, you're providing the various aspects, but you're not giving it real data. So all those are some pretty cool, data science, projects which are coming up nowadays.
Sure. Is that your class tomorrow?
The one tomorrow, yes, it's at noon. It's
the manufacturing data. Until you just said it, I didn't understand what the class was going to be about. I was like, what the heck is he talking about?
Yeah, you should attend it. Steven Johnson is a good speaker. So, and the other cool insurance example I wanted to share was it's all about collateralization and creating, products, derivative products out of insurance products. Because once you have these, and there's a lot of, in the past, when I used to build those kinds of models, you would just say, take a pool, build a stochastic model, project, discount. Okay, now you have these things, and now you kind of, build these pools. Now you're kind of evaluating the social data, the location data, and you're kind of building these unique pools. And now you're classifying these pools and saying, what am I actually buying? How am I rating this particular pool based on how many of them are like really good drivers, or how many of them, and that becomes pretty scary when you think about, life insurance securitization, because you're now thinking about not only because of the way we are, today Amazon is now, PillPack is taking your prescriptions, and I just wanted to log in and figure out, and it basically asked me all my doctors, and they were ready to like answer all my questions. So basically, they, if I say I'm going to this particular doctor, they already have, even if I say, do you have any allergies? No. Do you have any medical conditions? No. But I'm seeing this doctor and I'm seeing this doctor. So why would you see this doctor if you did not have this condition, right? So now you're kind of basically revealing everything to Amazon. And guess what? They're going to start prescribing medication for you, and it will come in like every 15 days now that they know everything about you.
I think the global financial crisis and all the Gaussian copula mortgage models ended up creating economic snipers out of their entire profession.
Now, the next thing is probably going to be like we creating our own digital twins, and that way we can like hide our own real identities and let our digital twin, reveal only the things it knows it should reveal rather than we revealing it.
They have your DNA.
Jess's
From
background is in
23andMe.
genetic data, right?
Yeah, it is amazing. And I think that it's, I think there is going to need to be, just personally, I think there's going to need to be more regulation. And then when you think that, and then you see some of the folks thinking about the regulation, it's really a challenging thing. I don't know if anyone watched the testimony where the first round of kind of questioning Mark Zuckerberg, not the recent round, but the one that was a little bit ago. And, a lot of these folks don't even know who's Facebook and who's Twitter and who's, TikTok, and maybe they're learning about TikTok. But, so I think it's, it's a spot where, hopefully we'll get more, smart people going into the science policy piece of that. I don't know. That's not where the money is. I know. I have a good friend from my biophysics PhD program who moved to DC to work on science policy. And he said he got there, right before no one cared about science policy anymore for a while. Now he works for a VC firm.
On the other hand, imagine George Church being in charge of legislation for genetic data. He'd have us all coded within a couple of months, and health insurance would cost according to what the roll of the dice was.
Yeah, it's a good point. You actually don't know whether to wish for like more or less competent people in some of these positions. That's right. Yeah.
Was this when Zuckerberg was or wasn't under oath?
Yeah, I'm thinking. The one I'm thinking of is when they sort of accused him of having something to do with one of Twitter's policies. I can't remember. Just, there'll be these really embarrassing interview things where you just feel like, oh my gosh, what hope do we have here? But
imagine a giant series of tubes.
Yeah, well, exactly. So, I think that continues to be a really, really interesting space. But look, I'm going to have to bow out because I can hear people like running above me. So before it goes into total chaos.
Thank you very much. And I forgot to mention that you had been back. This is your return visit. Was it like in the early days of Quantopian?
Yeah, that I gave a Boston Quaff a few talk. I think that's right.
Yes. Okay.
And
so anyway, welcome back.
Trading show like 6 years ago. So this.
Yes, it's great to see a lot of familiar faces. Good to see you again, Eric, as well. Really, really nice. Thank you guys for having me back, even though I didn't talk about quant finance and Matt.
All right. Thank you very much. Yes.
Cheers. Bye.
I've also shared the slides in the chat window for people who want to download or watch the video again. So you have the video and the slides.
Is there anybody up for December? You gonna have Santa Claus in?
You're our Santa Claus.
I'm just an elf. We'll work on it.
I'm always looking for speakers. So.
Okay.
All right. Well, it was great seeing everybody, and see you around.